It is Wednesday, June 26, 2019. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we will pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you will not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month, I'd like to highlight some of the key messages outlined in the materials posted at MATA-SII as part of our tri-annual update on U.S. developments. As such, I'd like to discuss the areas highlighted here. According to the World Trade Organization, the outlook for trade could worsen further if heightened trade tensions are not resolved. World trade growth will likely continue to remain weak in the second quarter of 2019. The new WTOI reading is 96.3, which maintains the weakest level since 2010. The WTOI remains well below the baseline value of 100 for the index, signaling continued falling trade growth in the first half of 2019. The latest results of the indicator was driven by declines in all but two component indices. Indices for international air freight, 92.3, automobile production and sales, 92.2, and agricultural raw materials, 92.4, fell further below trend. The index for container port throughput, 101.0, also declined but remained above 100, suggesting growth in line with recent trends. Indices for export orders, 96.6, and electronic components, 96.7, appear to have bottomed out, even as both remain firmly below trend. The WTO noted that there are significant downside risks for the 2019 forecast, and I quote them, "Any rebound in 2020 would depend on reduced trade tensions and/or improved macroeconomic performance." Central banks have normalized their balance sheets. Despite the Fed's marginal balance sheet reduction since 2018, which is about to end in September, the major central banks' balance sheets are still sitting at $19.4 trillion, up from the $6 trillion at the beginning of 2008. These massive injections, as you recall, were originally undertaken as emergency measures to help save the global economy and help set us on a new growth path. The overall central banks of the world have expanded their balance sheets by upwards of $22 trillion since the turn of the century, thereby massively monetizing the erupting public debt of the U.S. and most of the world via fiat credit snatched from thin air. So did that massive $22 trillion buy order from the central banks weigh heavily on the supply of funds side of the scales in the fixed income market, thereby driving bond prices skyward and yields ever lower? Why, goodness gracious, yes it did. The current worldwide regime of Keynesian central banking has so corrupted both financial discourse and pricing in the bond pits that this central bank balance sheet explosion is treated as inert financial wallpaper, utterly irrelevant to the whys and wherefores of daily actions of sovereign politicians. Moreover, the entire system is so mired in the fantasy called debt doesn't matter, both public and private, that in fact debt levels to GDP are still rising. The yellow line gives a little better granularity of the change in the balance sheet expansion. It is the U.S. which is reducing its balance sheet. As such, it is pulling U.S. dollars from the global liquidity pool. As a consequence, we have U.S. dollars and a euro dollar shortage. Global dollar liquidity is an increasing problem. What the central banks are discovering is there is simply too much leverage based on low rates, cov-lite, and available credit. Synchronized global growth has turned into a synchronized global slowdown. Growth has already turned negative in two of the world's largest economies, Japan and Germany, and is slowly, rapidly in the world's biggest economies, China and the U.S. When the next crisis happens, the Fed will cut rates back to zero, but it won't be enough. Then they'll have to abandon QT, quantitative tightening, and go back to quantitative 4, 5, and whatever. Other central banks will follow the Fed's lead. The market sees this coming, but the Fed is only now seeing it coming. Investors should prepare now for the inevitable final crack-up boom. The Fed will lower rates to the zero bound. However, bond yields will stubbornly stay high due to the shortage of foreign buyers to buy U.S. Treasuries. The U.S. dollar can then be expected to begin to fall. A weaker dollar will make U.S.-based global equities more expensive in U.S. dollars. A final crack-up boom will unfold. I think more and more global investors are sensing this, and this is why we are seeing a mind-blowing chart like this. The media and analysts say it is because the bond market sees something the equity market doesn't. The bond market sees a recession looming, while the U.S. equity market is falsely believing that the markets are fine because the U.S. economy is fine. I suspect it is more that the bond market is absolutely right, and many believe the outcome will be a debased dollar, which will push U.S. equities up in dollar-denominated terms, and that's what the chart is showing. Or one like this. Our U.S. business cycle analysis suggests we are quickly moving towards late cycle. The credit cycle, not shown here, but which we have shown in previous videos, is much further advanced, suggesting that this cycle slope is much steeper than shown here. We are not yet seeing distressed debt rising, which is normal at this point in the cycle. We suspect it is being hidden by the fact that according to the Bank of International Settlements, somewhere between 12 and 20% of all global corporations can now be labeled zombie corporations, where their profits or cash flows don't match their debt payments. They're surviving by rolling debt over and financing interest payments with simply more debt. Measures such as falling stock values are being held up to sustain monetary policies of easy money. However, we are seeing endless numbers of indicators that warn of an impending recession within 12 months. The late-stage credit cycle may last longer than presently anticipated by the markets if the central bank money spigot is once more opened up to full throttle. This will only delay the inevitable, and therefore the coming global U.S. recession will also be both much longer and more painful. We have posted many economic indicators on MetaSII covering various economic indicators. Let me just focus on just one of the recently released regional Federal Reserve surveys. Against expectations of a small drop to 11, the Empire State Manufacturing Survey collapsed by the most on record, from 17.8 to 8.6 in June. This is the first negative print since October 2016. This was a 10 sigma below expectations. This is the biggest month-over-month drop in the survey in its history, led by a complete collapse in new orders. Additionally, contraction, not slowing, was evident throughout the survey. Number of employees fell, work hours fell, inventory fell, 6-month general business conditions fell. The Morgan Stanley Business Conditions Index collapsed by 32 points in June, the largest one-month decline on record, to a level of 13, a low since December of 2008. In a functioning capitalist system, savings fund investment. However, the savings must go dominantly into productive assets. If it does, it increases productivity, which increases standards of living. Savings come from two sources, the consumer or corporations. The problem is both sources are spending the savings not on productive assets, but in the case of the consumers on consumption, that is spending beyond their means, and in corporations on stock buybacks or financial engineering. Let me highlight some of the key U.S. policy issues. Monetary policy, the wealth effect is no longer offsetting slowing credit growth. Fiscal policy, the ability of the U.S. government to fund the growing fiscal deficit. Public policy, the possibility that the number of mounting Trump trade wars will soon deliver an inflation shocker. Let's go through them. First, monetary policy. The Federal Reserve has been well aware since 2008 that credit growth was weak and would likely remain below the critical 2% threshold. That has meant the U.S. economy would remain dependent on asset price inflation if it was to avoid falling into a recession. That sustained dependence has slowly trapped the Fed and made it hostage to the stock market. It wasn't by design, but rather a natural evolution of a slowing rate of growth of the global economy. Presently, the Fed simply can't afford to let stock prices fall, or for that matter, even flatten out. That has meant for some time now that the Fed would have to begin cutting rates in 2019 to make sure asset prices kept rising if the economy was to continue expanding, even at a slower rate. This obviously flies in the face of lowering rates when the U.S. economy is supposedly strong. The Fed has therefore been trying to spin this distortion since the fall of 2018. This has given Chairman Powell the untenable task of convincing the public that low inflation is bad, The strong U.S. economy needs help, that full employment requires rate cuts, not historical rate increases, that quantitative tightening must be stopped, and soon new quantitative easing measures are once again required. The answer has been to blame it on the global economy and trade wars. That is true, but it is also flawed because it is the Fed's choking of U.S. and euro dollars that has precipitated the rate of global slowing trade. Since 2008, things were holding together regarding asset inflation. On the surface, it appeared that the financial crisis was in the rearview mirror and it was time to tap the brakes on quantitative easing and ever so lightly on quantitative tightening. That blew up in Q4 2018, and the Fed has since had to abruptly reverse everything it had been espousing, or at least what the public had been buying. Tightening stops in September, and rate reductions now are likely to begin in July. If lower interest rates aren't enough to keep the economy from falling into recession, the Fed will launch quantitative easing 4 and whatever, or some political acceptable version of it. If the Fed is forced into a new round of quantitative easing, there's every reason to expect it to be temporarily successful. Quantitative easing 4 would drive asset prices higher, aid near-term economic growth, and push the looming recession out a little further, possibly until after the upcoming U.S. presidential elections. It is only a matter of time before this new quantitative easing scenario plays out. It may be sooner than everyone currently realizes, but nothing good is going to come from this, and it simply means that when the final reality sets in, this is going to be a serious correction, and this may turn out to be the new Great Depression. Though the Trump tax cut and the sugar high it created has run its course, the Fed and Congress are left with a mounting disconnect between slowing revenue growth and increasing debt servicing costs. The unwritten job of the Federal Reserve is to ensure the U.S. government can be financed. High rates are problematic, especially when tax revenues at 15% of GDP result in a 400% debt-to-revenue ratio. The monthly budget deficit is exploding Treasury supply. Meanwhile, foreign buyers have been steadily reducing U.S. Treasury holdings. If the CBO projection history is any indication, you can expect this chart of Federal Reserve interest as a percentage of GDP to be much worse. Interest payments can be brought down to zero-bound Fed policy. This will likely mean sacrificing the U.S. dollar. That's the issue. A falling U.S. dollar is on the horizon without almost any doubt. As if monetary and fiscal problems are not sufficient, public policy is adding dramatically to the problem. The U.S.-China trade tensions have escalated significantly. Trump first doubled down on trade war with China, then he escalated a trade war with Mexico, weaponizing tariffs as a means to achieve his border policy. I don't believe the Mexican tariff situation is fully resolved yet. Meanwhile, Trump completed the trifecta when last week he also dragged India to the precipice of another trade war. All of this impacts trade and growth, but there's something else it impacts. Tariffs are a tax on U.S. consumers. It is the U.S. consumer and their U.S. distributors who will pay the tariffs in elevated consumer prices or shrinking profits. Walmart and Target, as examples, have already approached the president on the magnitude of the impact to U.S. retail prices it will be forced to implement. It has thrown the retail space into chaos, while currently farmers are getting all the headlines. Unless this is soon resolved, an inflation shocker is coming. That is something that the U.S. monetary and fiscal policy is frankly ill-equipped to handle. The catalyst of a global trade slowdown, potential global recession, and an overdue cyclical U.S. recession together sounds like a potential perfect storm. In the upcoming July long-wave video entitled SII Update Second Half of 2019, we will discuss the investment strategies used or could be used for such a scenario. So in closing, as I always remind you, remember, the answer will be to print more money, and that is turning out to be the case more and more every day. It's the only answer politicians will ever agree on. That is, until no one wants the money or trusts it. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2019 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.